Retiring on dividends, that is the dream for so many, including myself. And there's good reason for it. I mean, first of all, just retiring on your income is great because as some have famously said, I would rather live off of the labors, off of 1% share of the profits of 100 other people than 100% of the profits of my own, because you're not having to do any work that way. And that's effectively what you're doing. When you are buying dividend stocks or dividend ETFs or CEFs, you're effectively buying the labors of others to feed yourself, to pay yourself, because you're buying little slices of companies that are money-making machines, and these dividend stocks are not just money-making machines in their own right, but they share those dividends, those profits with you by spinning off cash flow. And that goes straight to your checking account. You don't have to do any work. You can just sit back, relax, and let the dividends flow. So that's great. It frees you up to pursue all sorts of things, whether it's fishing or golfing or spending time with your family or doing missions work, serving in your local church, studying something that you're really passionate about, starting a business but not worrying about having to become profitable immediately. Whatever it is, it sets you up for a lifetime of freedom and legacy, because if you are an intelligent dividend growth investor especially, your underlying portfolio is going to still continue to compound in value. For example, like the Schwab US Dividend Equity ETF or Realty Income or many other popular dividend growth funds and stocks. What they do is they pay out that hefty dividend year after year after year that you can live off of, but they actually increase the dividend year after year. And if you look at the long-term trajectory of the company, the stock price has risen materially over time despite paying out those significant dividends. And so you're getting growth underlying that you can pass off to your heirs. You're getting an ever-growing stream of passive income that meets your current expenses and offsets the corrosive impacts of inflation. And ultimately, you have that money-making machine that you can pass on to heirs someday to help them with whatever God has for them to do with their lives. So retiring on dividends is a great thing. However, while it sounds wonderful, as most of you probably know, and I know from personal experience, it's a lot easier said than done. The math looks great. Buy the Schwab US Dividend Equity ETF. It yields 4%. You can expect it to grow at probably a high single digits CAGR moving forward. Over the past 10 years, it's grown at a 10% CAGR. So, it's got a good track record. Easy. Sit back, relax, and let the dividends flow. Well, for those of you who have followed SCHD, it has materially underperformed the broader market in recent years. In fact, it's even underperformed a lot of other dividend growth ETFs. So there's the emotional aspect. It's like, okay, well, the income's coming, it's growing, but the total returns are not really where I want them to be. And so that can cause you to potentially shift off course. Or maybe you build a portfolio of individual stocks. Maybe you load it up on high-yielding CEFs that yield 10% on average, or BDCs, or something else like that. And suddenly the leverage kicks in and it crashes your retirement. Or maybe you bet heavily on Walgreens Boots Alliance or 3M or VF Corporation or AT&T, all proven dividend aristocrats, dividend kings, dividend challengers, whatever they are, impressive dividend growth track records, seemingly blue chip companies, and they slashed their dividends and you got burned. Or maybe you're even in the likes of NextEra Energy Partners, which not only had an attractive yield but an incredible dividend growth track record, and suddenly just completely eliminated its dividend. You got the rug pulled out from under you. So there are many ways that you can falter on your dividend journey. And so in today's video, I'm going to just talk about really what are the keys to retiring on dividends, as well as how much you need to reasonably retire on dividends. Now, again, this is not financial advice. This is just my opinion based on my own research and my own experience. So keep that in mind. No returns or results are guaranteed. But anyway, if you like this sort of content, again, dividend wisdom, dividend philosophy, individual deep dives on dividend stocks and dividend funds, which I do a lot of, please like this video, subscribe to this channel, hit the notification bell. You'll get a lot of value out of it. Speaking of retiring on dividends, one of the very best investing trackers that I've ever seen is Snowball Analytics, and it's really good, especially for dividend investors. What I like about it, for one thing, is you can upload your portfolio manually, or you can use your brokerage statement or even connect to your brokerage account to automatically update your holdings and your buys and sells in real time. And obviously, here's the model portfolio. This isn't actually what I hold, but it has some really cool tools for dividend investors. For example, the dividends tab gives you a full breakdown of your portfolio from a dividend perspective, your yield, your total dividends, your payout by position, both also percentage by position, the amount of reliable dividends, reliably rated dividends you get, your average annual growth by position, your future payments, and even better is the dividend calendar, which tells you by month how much you can expect to get, as well as annually, but also it shows on the calendar itself when you are going to get those payouts. So that's really cool. Another feature that I highly encourage you to take advantage of is the growth component. It tracks your total returns over all these different time frames. And by the way, that includes dividends. So it's really a valuable tool in that sense. And it shows how you're doing relative to the S&P 500 over time, which is really cool, really valuable tool. So hopefully you can make good use of this. There's so many other tools you can use on here as well to further learn about your portfolio and get all these neat graphics. Take advantage of a 30% off discount now through December 3rd for their Black Friday sale, and get an additional 10% off when you use the promo code in the video description or in the pinned comment below. Remember, you get a 14-day free trial to try it out as well. So make sure you take advantage of that and click those links below. Also, I want to let you know that I'm Samuel Smith. I run the highest ranked investing group on Seeking Alpha. We're also the fastest growing, and we are launching a Black Friday sale. We've been doing it now for a while, heading in towards our 5-year anniversary here in early December. You can get $100 off. It's a limited time special. You can get it through the link below in the video description as well as the comment section. I've also left below a link to monthly dividend stocks. You can get that list completely for free, and if you're looking to retire on dividends, monthly dividend stocks are a great way to do it because you get that cash flow every month. It lines up nicely with your living expenses you need to budget for, and so at least having some of those in your portfolio can ensure you get that regular cash flow. So make sure you take advantage of that free offer in both the video description and the top linked comment. All right, now let's get into the details here. So how you can retire on dividends and really know that you have enough to really be able to sit back and relax and not constantly worry about your portfolio. Well, a couple first principles you need. You need to have a portfolio that's filled with holdings that are adequately diversified and durable. And those work hand in glove with each other because the durability of your income stream is really what you're after here. You don't really care about anything else. At the end of the day, you want just your income to come in and to keep up with inflation over time, and preferably your principal to grow over time. Then you can pass it on to your heirs. Now, how you do that is really twofold. Like I said, diversification and durability. The durability means I'm buying businesses that I think are going to last well into the future. Obviously, no one knows exactly what's going to happen, but generally, as best you can tell, they're probably going to withstand disruption. So, for example, what not to do would be to buy, load up on Class B and C mall REITs back when, the Amazon was disrupting the retail industry, and you would have gotten burned. Those companies almost all went bankrupt or got bought out. So that's not a way to do it. You want a business that can last the test of time. But again, because the future is unknown, our judgment can be flawed at times. We can make emotional mistakes or just analytical, intellectual mistakes. Diversification helps to hedge against that. So, maybe a mixture of broadly diversified ETFs like SCHD, maybe a few others as well, along with individual stock picks and an adequate number of them. For example, I have around 25, give or take 5 or 10 stocks at any time in my combined core and international portfolios at High Yield Investor, which represent my personal dividend holdings. That helps you pretty well, especially if you accompany that with a diversified ETF. And SCHD does a good job from a qualitative standpoint, and then you got to do that yourself to make sure you are picking companies that are durable. Now, you also want them, at least most of them, to be defensive because, again, if they're highly cyclical companies, for example, LyondellBasell has a great dividend growth track record, but they've run into a major macro storm due to the cyclicality of their industry, and they may very well have to cut their dividend in the near future. It's not for sure yet, but it's quite possible. And then, of course, that's not what you want as a dividend investor. And there are many examples like that out there. So again, you want to at least overweight defensive companies that can be stable throughout the cycle for the most part in their dividends. You don't want too many cyclical plays because then you're going to potentially run into a tough time. Okay, so those are two things. And of course, companies with long dividend growth streaks generally, that's pretty safe, especially if they're a dividend aristocrat or a dividend king. You can know that they're generally pretty stable through the cycle. Then you also obviously want to emphasize getting a high enough yield because, again, if you're looking to retire on dividends, you need to realize, okay, maybe if you have a $10 million portfolio or more, or even $5 million portfolio, the yield component may not be quite as important for you because you have such a large amount of principal to work with. You more just want to say, okay, I want to have enough that comfortably covers me, but then I want to emphasize growth and durability to minimize risks to really, make sure you get the job done. Whereas, if you only have a $1 million portfolio, the yield may be a little bit more important to you, or even if you have less, especially, the yield may be a little bit more important to you. So again, depending on where you land on that scale, where you expect to have your portfolio principal when you retire, you need to have in mind, okay, this is how much I need from dividends to live off of. This is my expected portfolio size. So what is the yield I need to target on a weighted average basis? And then, of course, from there, you also want to look at coverage ratios of the dividend and, the balance sheet strength. Those both combined to, deal with the sustainability of the dividend. You don't want an over-leveraged balance sheet, even if it covers it fully with cash flows. They may have to cut it to try to strengthen the balance sheet. And even if they have a strong balance sheet, if they're not covering it with cash flows, they may eventually have to cut it anyway, obviously. And then, of course, the dividend growth component, you want to make sure that in aggregate, whether it be you're generating a surplus of income from a higher yield and you're reinvesting the yield to grow your income, or your companies intrinsically are organically growing their payouts at a rate that meets or beats inflation, you want to make sure that not only is your income sufficient today, but it's likely going to be sufficient for years to come because of, covering inflation. And then last but not least, you really want to have a margin of safety in there. And that's really the key to durability, because even if the math makes sense today, even if, let's say, you have a $5 million portfolio and, you expect that you're going to have big living, not too big of living expenses, you still, need to make sure that, you get enough. So maybe you only need a 2% yield from your portfolio to get that $100,000 a year that can cover your living expenses. And that's great. Then maybe a fund like DGRO will work for you just fine, or even SCHD with that little bit of margin of error. But you want to make sure you have that margin of safety. For example, SCHD would give you a 4% yield roughly. That would double it. Or you just could target a weighted average portfolio yield of 3 or 4%. And then you're getting plenty more than what you actually need to live on. Then you have that extra cash flow you can reinvest to give you a little bit of margin of safety. That margin of safety is so important because, again, you never know when a major war is going to break out. Maybe China invades Taiwan and we have a ton of dividend cuts, a global depression, or we just have another COVID, or we just have a fiscal crisis in the US and the dollar erodes its value quickly. We have mass inflation and suddenly your $200,000 that you're generating per year from your, $5 million portfolio is suddenly not so great. Even if before you only had to spend $100,000 to live on, maybe it's going to be much closer to $200,000. So, you want that margin of safety, or maybe you have a major medical expense or something like that pop up and you need to eat into your savings a bit or just, consume more of your income than you otherwise would have. So that margin of safety is so important. And that's really the difference is you want the math to work out, but then you want a margin of safety, and not just in your dividend income today or even in your projected dividend growth over time to make sure it keeps up with inflation and ideally exceed it so your living standard actually increases, but even outside of the market. So for example, having your home paid off, that can be a really great thing because, again, sure, maybe you have a really low mortgage and maybe you decide that's the way you want to go and leave it on there, okay, but maybe the mortgage rate is close to market rate. You have to realize even if you think you can earn a higher yield or return in the stock market, those are always on a risk adjusted basis and you never know the downside scenario that's going to happen. And so just paying off your house, that gives you another form of cash that you can tap into that's effectively earning interest because you're not paying interest on it. So therefore it's as if it was earning that interest rate that you're paying on your mortgage. And you can tap into your home, you can get a HELOC or whatever and get a line of credit and get some cash out that you can then use to take care of short-term issues that pop up or to take advantage of a market crash if you want to or whatever it may be. And then maybe having some emergency fund. And then also I think personally having precious metals like gold and silver is really valuable because, again, we don't know what could happen to the dollar down the road with persistent fiscal deficits and global de-dollarization. We don't know what could happen if the market crashes due to a war where there's a flight to safety, and gold would probably shine in that sort of scenario. So that's why I personally, have my gold. I have a good bit of gold and I have it mostly invested in stuff like monetary metals, which earn me a yield, a nice close to 4% yield on the leases that it's invested in, while I also have that gold over the long term as an additional safety hedge. And I actually have a link to monetary metals in the video description below, as well as and you can take advantage of that there. So anyway, those are kind of the principles that I'm looking at. And so again, how do you know how much you need to retire on? Well, again, it depends on a lot of things, but ultimately it depends on what are your living expenses today and what do you expect them to be over the long term, as well as how long is your retirement going to be. If you're retiring early, say you're retiring at 40 years old and you anticipate having you want to be prepared for maybe to live to 90 or 100, you need to make sure that you have a bigger margin of safety because there's a greater period of time for things to happen, both in terms of just the world and the macro environment, into the dollar, et cetera, as well as in your own life. And so you want to have a bigger buffer the earlier you retire. Unless, again, your retirement plan involves not really retiring, but just, working part-time on a hobby job or starting a business that you don't know how it's going to go. Okay, you still have time. You can go back and get a job again. It's not the end of the world if your portfolio lets you down, but you just got to factor that in. And then obviously you got to take into account where do you want to live, what your lifestyle do you want to have, and all of those factors. And so again, and then just having that buffer, I would say ideally at least a 25% buffer in terms of income, so relative to living expenses. So again, if say you want to live off of 4% of your portfolio, if you're targeting a 5% yield in your portfolio, that might be good. And then the higher the better, right? As Warren Buffett says, it's insanity to risk which you have a need to get something that you don't have and you don't need. So for example, if you can comfortably live off of just 2% of your investments, maybe it's better to just seek a 3 or 4% yield than to go out there after an 8% yield and think, oh, I'm going to generate all this income, I'm going to be rich and have all this passive income. Okay, great. I mean, if you know what you're doing, I'm not saying you can't do that, but don't just stretch for yield and take on extra risk for the sake of it because you want to get greedy. It's probably better to err on the side of safety and durable dividend growth and stable, lower risk compounding in retirement to make sure you just accomplish your mission of meeting your living expenses than chasing some, ridiculously high pipe dream just because you want to be able to say, oh, I bring in X amount of money in passive income, which is way more than you need. And then in the process, putting yourself at risk of dividend cuts and panic, etc. So hopefully that makes sense. I think it hopefully adds some value to you. Again, be sure to take advantage of that free link to monthly dividends in the comments section and the video description, as well as the $100 off sale at High Yield Investor. You can take advantage of us. We walk you through. We have a retirement portfolio there for people who want to get ideas for building their own retirement dividend portfolio. We also have a core and international portfolio that are more total returns focused while still generating a high yield. In aggregate, it's about 7 or 8% yield in those portfolios. It's my real money, my trades on the line. You can learn all about it. You get my deep dive interviews, my in-depth analysis, regular quarterly updates, live chat where I answer any of your questions. So anyway, hopefully that's valuable to you. Take advantage of that. With all that said, thank you so much. See you next time.